Hi, Tom Lydon with ETF Trends here in Washington, D.C. at the Charles Schwab Institutional Conference. Here with Kevin Baum, Chief Investment Officer of USCF. Great seeing you, Kevin.
Good morning, Tom. Good to see you. Thank you.
There's a lot going on, not only in the markets, but a lot of saber rattling regarding trade talks. Give us some perspective.
It's the big story right now, right? It's affecting Chinese economy. It's affecting the U.S. to a smaller degree. Most economists think it's going to shave about 0.25% off of GDP growth, but it's really having an impact on emerging market equities, and it's depressed commodity prices as well. But if there's a positive change in tone, we could see prices pop once some of the pressure comes off.
Well, Trump's been very tactical in kind of going around the world and working things out with other countries, in tune, kind of putting pressure on China to maybe get them farther over the barrel. What do you think?
Well, that's the question. How much of this is rhetoric and how much of this is going to be substantive? And clearly the markets have priced this in, expecting a continuation of these tariffs. Yeah. But again, if there's some relief after the election, we think that industrial metals prices, agriculture prices could significantly recover, maybe 10-15% price recoveries, because that's what has sold off since the tariff war started.
Yeah, so thinking about that, we know bonds and stocks have done pretty well over the last 10 years. Non-correlated assets have really gained some popularity recently. Why is that important to make sure we have that allocation in the portfolios?
Sure, well, commodities can provide positive returns, but very importantly, they're diversifiers. Just as you mentioned, they're negatively correlated to stocks, negatively correlated to bonds, so it makes sense for advisors to put 5 to 10% of client portfolios into commodities. And when we think about the risk in the world today, Tom, we think about geopolitical events, we think about rising rates. Commodities have significantly outperformed stocks and bonds in those environments historically.
Yeah, so when you look at USCF and you have a whole variety of choices, options, run through a couple that might work well based on the current scenario.
Sure, well, I think most people are familiar with USO. That's the first and largest oil fund in the category. And of course, if we want exposure to the oil asset class, that's a great way to play oil. But more broad or diversified exposure via USCI, we think is the prudent way for advisors to give their clients access to the commodities asset class.
And break that down for us.
Right.
In USCI, what's in there?
Well, implementation in this asset class is critical, Tom. If we think about equities, S&P 500 versus Russell 1000, there's not much return dispersion there. But if we move to commodities, there's on average about 800 basis points per year of dispersion between the major indices. So USCI is a factor-based approach that looks at momentum, but also the shape of forward curves. And historically, that's allowed the fund to outperform the competitors by 3 to 5% per annum.
And the constituents include a wide variety of commodities, correct?
That product chooses from an opportunity set of 27 commodities and then rebalances every month, holding 14 of the best performing commodities each month.
Excellent. Well, Kevin, great seeing you.
Yeah.
Thanks for coming by.
Thanks, Tom. Appreciate it.